Welcome to The Explainer. Today, we're diving into the story of an absolute titan in the digital economy, a financial force that is somehow as chaotic as it is totally dominant. Imagine, for a second, a digital token that was designed to be perfectly boring. It was supposed to just perfectly mirror the US dollar. But instead, it becomes the absolute center of billion-dollar hacks, shadow banking scandals, and intense regulatory crackdowns. Yet, despite all of that, it has somehow become the undisputed backbone of the entire cryptocurrency market. So, how on earth did a token meant to be boring become the gravitational center of the crypto universe? Let's get into it.
All right, to really wrap our heads around Tether, you have to understand the sheer scale of this thing. As of the third quarter of 2025, Tether's market capitalization hit a staggering $175 billion. That's a 25% increase from earlier in the year alone. That means Tether isn't just some niche digital asset anymore, it is practically a sovereign financial entity. In fact, it actually ranks right up there among the largest holders of US Treasury securities outside of actual sovereign governments. The scale here is absolutely massive, and the stakes for the global financial system, and hey, potentially even your own crypto portfolio, are incredibly high.
But honestly, that market cap is only half the story. Get this. Tether is processing around $144 billion in daily trading volume. That absolutely dwarfs Bitcoin itself. To put that into perspective, Tether moves more money in a single day than the entire annual GDP of a small country. It commands about 60% of the overall stablecoin market, making it the primary liquidity instrument globally. We're not just talking about a token here, we're talking about the fundamental plumbing for the entire crypto economy.
Moving into Section 1, how Tether actually works. Let's look at the mechanics of a one-to-one peg.
Now, you might be wondering, what exactly is a stablecoin anyway? Well, unlike Bitcoin or Ethereum, which we all know can be incredibly volatile, USDT is designed to be pegged one-to-one with the US dollar. But here's the absolutely crucial distinction. It operates on an IOU model. It completely relies on full collateralization, meaning Tether claims to literally hold one physical dollar in reserve for every single digital USDT they issue. This is fundamentally different from those algorithmic stablecoins, like the ill-fated Terra network, which rely on complex code and arbitrage to maintain their peg instead of hard cash.
In practice, the life cycle is actually pretty simple. Say a user or an institution deposits real US dollars into Tether Limited's accounts. Tether then mints the exact digital equivalent in USDT. From there, you can instantly beam that value across the globe on networks like Tron, Ethereum, or Solana. You're completely bypassing traditional banking hours and clearing settlements in literally seconds. And it just stays in circulation out there until someone decides they want to redeem it back for physical cash. It's designed to be this incredibly seamless 24/7 bridge between traditional fiat and crypto.
Which brings us to Section 2, Hacks, Missing Millions, and Fines, a highly controversial history.
Because, let's be real, the reality of Tether's rise has been incredibly chaotic. Back in 2016, its sister company, the cryptocurrency exchange Bitfinex, suffered a massive $72 million hack. Then, struggling to find traditional banking partners, they ended up turning to a Panamanian shadow bank called Crypto Capital. Well, that relationship eventually led to $850 million completely vanishing in 2018. By 2021, all of these practices sort of caught up with them, resulting in an $18.5 million settlement with the New York Attorney General, plus a $41 million fine from the CFTC over misleading claims about their reserves. Now, what's really shocking here is that the 2018 event, because it's the absolute crux of so much of Tether's regulatory scrutiny, when Bitfinex lost access to that $850 million held by Crypto Capital, money which had actually been seized by global authorities, Bitfinex quietly dipped right into Tether's cash reserves to cover that massive shortfall. Regulators argued that commingling client and corporate funds like that without clear public disclosure was a massive violation of trust. For the everyday investor, this basically shattered the illusion that every single digital Tether was backed by a physical dollar in a vault at all times.
All right, Section 3, Breaking the $1 Peg. What happens when the stablecoin becomes unstable?
You'd think a coin with stable in the name would, remain stable. But historical liquidity cascades show us something wildly different. In December 2017, the price actually hit $10 on Exmo. Then in January 2019, it completely crashed down to a tenth of a penny on OKCoin. And in May 2019 on Kraken, it skyrocketed to an unbelievable $1,000 per USDT. So why does this happen? Well, when demand completely overwhelms an exchange's local order book, like when traders are desperately panic buying or panic selling, the price simply detaches from reality until global liquidity can finally catch up and arbitrage the difference.
Let's pivot to Section 4, beating USDC and stress tests, proving resilience. When you put Tether head-to-head against its closest, highly regulated rival, Circle's USDC, the disparity in market preference is honestly striking. While USDC is heavily respected and utilized in institutional decentralized finance, sitting at a totally respectable $73.4 billion market cap in Q3 2025, Tether just completely dominates broad market liquidity. USDC saw some erratic peaks and troughs this year, sure, but Tether's growth was this steady climb straight up to $175 billion. Tether is processing up to $144 billion in daily volume compared to USDC's max of about $40 billion. The open market clearly favors Tether when it comes to raw, everyday liquidity.
But hey, the ultimate test of any financial plumbing is a full-blown crisis, right? Think back to the periods of immense market panic, specifically around the catastrophic collapse of the algorithmic stablecoin Terra. Panicked investors were rushing for the exits, desperately trying to redeem their USDT for real dollars, and Tether successfully processed $10 billion in direct redemptions in just 48 hours. That was over 10% of their outstanding tokens at the time. The reality is, practically no traditional bank in the world could process a 10% withdrawal of their total assets that fast without facing an immediate, catastrophic liquidity crisis.
To actually survive those epic bank runs, Tether had to fundamentally change its DNA. They've aggressively backed away from riskier commercial paper. Today, a massive 55% of their reserves are parked in highly liquid, incredibly safe U.S. Treasuries, and they've reduced commercial paper down to 29%. This strategic shift is designed specifically to ensure that when the market panics and the brutal sell-offs begin, Tether actually has the liquid cash equivalents on hand to honor every single withdrawal without even blinking.
And that leads us right into our final chapter, Section 5, the big KPMG audit era, the push for legitimacy.
Look, Tether absolutely knows they've had a trust issue over the years. Their CEO, Paulo Arduino, has essentially drawn a line in the sand. He stated, Tether's mission has always been to build trust through action. For years now, the broader crypto community and traditional finance institutions have been begging for a full, traditional audit, and Tether has insisted they are actively working toward total, undeniable transparency.
But to be completely fair, we have to balance that promise against some serious, historical, regulatory skepticism. The New York Attorney General once put it incredibly bluntly, stating that Tether's claims of being fully backed at all times was a lie. For nearly a decade, Tether has provided these periodic snapshots and attestations, sure, but never a full financial statement audit conducted under generally accepted auditing standards. That lingering gap between Arduino's promise of trust and the NYAG's deep skepticism is exactly what their newest initiative aims to resolve once and for all.
Which brings us to 2026. And this time, Tether isn't just making promises. They have officially hired the Big Four accounting firm KPMG to conduct its first-ever full independent financial statement audit. Plus, they've brought in PwC to tighten up their internal systems and controls. On top of that, they just launched a new stablecoin called USAT, which is specifically designed to comply with the new Federal Genius Act framework in the US. And to show you just how serious they are about this, they literally paused a $20 billion equity raise, which would have valued the company an astronomical $500 billion, just to make sure they get this audit finalized first.
So, that leaves us with one massive lingering question. Tether has survived the hacks, the massive fines, and some of the craziest market stress tests imaginable to become this $175 billion giant. But as KPMG finally pulls back the curtain for the first true audit of the ultimate stablecoin, will the crypto backbone finally achieve undeniable institutional legitimacy? Or is the biggest shock in financial history yet to come? It is absolutely going to be a fascinating space to watch. Thank you so much for joining me for this explainer, and keep questioning the data.